Assalamu alaikum. Welcome to our presentation. Our presentation topic is Silicon Valley Bank failure. This presentation is presented to our Honorable Teacher MD Shagulana, Assistant Professor, Department of Bank and Insurance at University of Rajshahi. Thank you, sir. And this presentation is presented by our whole team members. They are MD Shakil Mia, Samira Nusrat Lawar, Sharifur Rahman Onto, Sharojit Sarkar, MD Ramzan Hassan, myself Nurunhar Khatun, Baby Nasrin, and Wahidul Islam. Let's begin our main session. What is the Silicon Valley Bank? Silicon Valley Bank is a commercial bank division of First Citizen Bank shares. Previously, it was a subsidiary of Silicon Valley Bank Financial Group that has a strong presence in multiple US states and international jurisdictions. Silicon Valley Bank benefited significantly from the explosive growth in tech sector. Its asset experienced exponential growth, tripling from $71 billion in 2019 to a peak of $220 billion by March 2022. Deposit surged from $62 billion to $198 billion over the same March period. Despite recent challenges, Silicon Valley Bank remains a key player in the financial landscape and continued growth and innovation. Now, the history of Silicon Valley Bank. It was founded in 1983 in Santa Clara, California by Bill Bickerstaff and Robert Catter to the needs of startup companies. Through innovation, loan structures, and strategies aligned with venture capital funds, Silicon Valley Bank became a pivotal player in the tech startup ecosystems, experiencing robust growth throughout the 1980s to 1990s. Despite facing challenges during the 2007 to 2008 financial crisis, it demonstrated resilience and expanded its global presence, establishing operations in key tech hubs worldwide. By 2015, Silicon Valley Bank proudly served a significant portion of US startups and earned recognitions from Forbes as one of the American-based banks. However, a severe crisis in 2023 led to regulatory interventions and the eventual transitions of Silicon Valley Bank to First Citizen Bank and Trust Company, highlighting both the bank's stories of innovation and its challenges in the modern financial landscape. The products and services of Silicon Valley Bank. Silicon Valley Bank has been at the forefront of catering to the distinctive needs of startup companies since its inception in 1983. At present time, Silicon Valley Bank's business expertise are business stage. It incorporates startup banking, venture-funded corporate banking. On the other hand, investors incorporates private equity, venture equity, and corporate equity. If we say about the products and services of Silicon Valley Bank, then it will be the business banking that incorporates business checking, payment, and business credit cards, online tools, and integrations, preventions, and lending. Then global business solutions, liquidity solutions, and global fund banking. Now, the collapse of Silicon Valley Bank. Silicon Valley Bank's collapse came suddenly. Silicon Valley Bank went down because it made risky investment and didn't follow the rules well. Between 2019 and 2022, the bank grew a lot and landed too much money. The bank invested in the treasury bond for the long term from the significant portion of the fund. But because of increasing the interest rate, the value of those bonds decreases. This time, fear of losing their money, the investors withdrew their money within 84 hours. And this is a very significant portion. So the bank had faced liquidity crisis. And this is the main reason of collapse of Silicon Valley Bank. From this point of view, on March 26, 2023, the FDIC announced that First Citizens Bank shares would acquire the commercial banking business of Silicon Valley Bank. As part of the deal, First Citizens purchased around $119 billion in deposit and $72 billion of Silicon Valley Bank's loans discounted by $16.5 billion, while around $90 billion of Silicon Valley Bank's securities remain in receivership. That's all from me. Now I would like to invite our next team member to continue this session.
Thank you, Runa, for calling me. Today my topic is timelines of major event. First one, 1983 to 1990. Silicon Valley Bank founded, focused on startups, expanded to East Coast and achieved profitability. 19, 1990 to 1997, diversified into real estate, faced lazy benefit and dot-com bubble. Next, 2000 to 2027, maintenance task focused, entered private banking, expanded globally. Next, 2011, received trap investment during financial crisis, leadership changes. 2012 to 2018, collaborate in China, dominated US startups market, and 2011, 2019 to 2021, legal issue with considered trading potential reputation damages and impact during COVID-19 pandemic. 2022 to 2027, Russia-Ukraine war, geopolitical tension and diverse loan portfolio encompassed venture capital, private equity, high net worth mortgages. Next, I will call my next team member to present our session.
Thank you, Shakil. Now, as my previous presenter already told, several major events of Silicon Valley banks, now I am discussing the time when the collapse actually happened. As you see in the slide on there is an infographic where we see that on March, their Silicon Valley Bank suffered a $1.8 billion loss due to the devaluations of the investment like treasury and mortgage bonds. On March 9, Silicon Valley Bank shares plummeted by the 60% as investor view worried about its financial troubles, promoting depositories. On March 10, where the actual collapse happened, Silicon Valley actually faced a rapid surge fund withdrawals, leading to near collapse, prompting the FDIC to step in to safeguard depositor funds. On March 11, prominent investors and tech executives criticized the government for not taking further action to rescue Silicon Valley Bank. Now let's break down these events. On March 8, Silicon Valley said they lost 1.8 billion by selling some investment like treasury and mortgage bonds. This investment dropped in value because the Federal Reserve raised interest rates a lot in the past year. To make up for the loss, the bank wanted more than 2 billion to make its financial situation stronger. On March 9, shares of Silicon Valley's bank fell 60% in response to the investor concern about the bank's distressed financial position. Depositors in Silicon Valley Bank, a relatively small group made up primarily of venture capital firm and tech startup, began to withdraw their funds from the banks. On March 10, when the actual collapse happened, the rapid withdrawal of the funds gained a momentum, putting Silicon Valley Bank on the verge of the collapse since the bank could not generate enough cash to meet the need of the depositors. The government agency, FDIC, took control of the Silicon Valley Bank to keep people's money safe. This bank is insured by FDIC, which means if you have less than 250,000 in your account, your money is protected. But lots of people had more than that in their account at this bank, so they might lose some or all of the extra money they had beyond the 250,000. On March 11, there are prominent investors and tech executives criticize a perceived lack of government actions to rescue the Silicon Valley Bank and its depositors beyond the guarantee of 250,000 for each account held. Thank you. Now I call my next team member.
Thank you, Mohsin. Now I will present my presentation topic, moments of failure of Silicon Valley Bank. There are two major reasons behind this: heavy loss in the bond portfolio of Silicon Valley Bank and bank run. How did this happen? Let us have a look into the balance sheet of the firm. Well, it looks diversified just like any bank. Let us have a look into the deposits. Here we can see 2019 to 2021 more than thrice. This was due to COVID-19. Interest rates were lower 50%, so the business can thrive. Silicon Valley Bank decided to invest these deposits in securities, 77% in HTM and 21% in AFS. The interest rates were lower, and fund managers anticipated that it would continue to do so. In the period of 2017 to 19, they generally invested around 50% in HTM and AFS. Then, in March of 2022, Russia-Ukraine was started off. Inflation rates started to rise. Fed accelerated it by increasing the interest rates. As the war never stopped, geopolitical tensions rose and interest rates spiked. That's all from me. Now, I would like to invite my next group members.
Thank you, Anto. As my previous team member discussed about some of the topics, now I'd like to elaborate on these other points of this topic. So, come to the first topic. The first topic is the bond portfolio of SVD, that means Silicon Valley Bank pledge. That means bond value drops as interest rates rise. As the majority of investments were in held to maturity, that is HTM securities, they were unable to sell it. And Silicon Valley thought tensions would ease and interest rates rise will drop, but that never happened. Next is venture capital, which we can see from the balance sheet that venture capital firms and the private equity funds got information about these and asked the startups to withdraw their money in order to pay from the Silicon Valley Bank realized losses of $1.8 billion by selling proportion of the portfolio. Now, then to cover it from the Silicon Valley Bank offered common stocks in primary market to raise $1.5 billion, but failed miserably. And also you can see that major of the depositors were above the cap of $250,000, and well, it's not insured by the government. So this led to the panic and bankrupt. So the depositors rushed to withdraw, and bank provided for it by selling its already making loss portfolio. This series of occurrences led to the breakdown of the Silicon Valley Bank. And we can see from the balance sheet that the non-interest demand is more than thrice from 2009 to 2021. And we also see that total investment security ratio is 77% in HTM securities and 21% in AFS securities. And we also see that the total investment securities ratio in the total held to maturity securities is 47.6%, and the total available to sell securities is 48.2%. Thank you so much. This is all from my today. Now I'd like to invite my next team member.
Thank you, Pampo, for calling me. Today, my discussion topic about why did it collapse? The Federal Reserve's decision to raise interest rates due to soaring inflation rendered Silicon Valley Bank's bonds as risky assets. Consequently, the value of Silicon Valley Bank's bonds declined as investors sought higher yielding alternatives. Simultaneously, financial distress among some of the bank's technology industry clients prompted significant fund withdrawals. In response, Silicon Valley Bank opted to sell off some of its investments, incurring losses amounting to $1.8 billion. This downturn marked the onset of the bank's demise. Reason of failure. The collapse happened for multiple reasons, including lack of diversification, classical bank run, poor risk management, inadequate of stress testing, consequences of overconfidence, lack of transparency and communication, where many customers withdrew their depositors simultaneously due to fears of the bank's solvency. Many of Silicon Valley Bank's depositors were startup companies. The deposited large amounts of cash from investors because tech was in high demand during the pandemic. Zhe Zhang, founder and managing partner of Embark Advisor. Thank you.
Thanks, Devin Nazmin. Now I would like to discuss the reason of failure in details. The first reason is lack of diversification. Diversification means invest your asset in different sectors. Silicon Valley Bank invested a large amount of bank deposit in long-term US Treasury and agency mortgage-backed securities. However, bond and treasury value fall when the interest rate increase. The another reason is bank run. Silicon Valley announced their 1.5 billion capital rising on March 8. People became alarmed the bank was short on capital. What spread quickly, the social media accounts such as Twitter and WhatsApp induced panic that the bank did not have enough funds. This news are also the region of collapse the Silicon Valley Bank. Another core risk management. Risk is the uncertainty of future event. Silicon Valley Bank risk management system and processes were not robust enough to identify and mitigate potential risks. The another reason, inadequate of stress testing. Stress testing a bank is an analysis to determine a bank has enough capital to against on financial loss. Because of the lack of stress testing, the Silicon Valley Bank were collapsed. Consequence of overconfidence. Silicon Valley Bank's leadership exhibited overconfidence in their investment decision, which may have contributed to the lack of diversification and risk management failures. And the last reason of failure is lack of transparency and communication. Silicon Valley Bank's lack of transparency and communication with investors and stakeholders contributed to the severity of the collapse. Clear and open communication is crucial for maintaining trust and confidence. So the collapse of Silicon Valley Bank highlights to the fatal impact of market risks, which can hit any business or industry very quickly. This emphasizes the need of efficient asset liability management and proactive risk management process. That's all of my side. Now I would like to our next member.
Thank you, Ramzan Hussain. My selected topic is lesson learned from Silicon Valley Bank collapse. The collapse of Silicon Valley Bank on March 10 has sent shockwave through the tech industry, with thousands of startups losing access to large amount of their money over the weekend. The collapse, triggered by a bank run, led to the bank taken over by the FDIC. The aftermath of the Silicon Valley collapse left many entrepreneurs scrambling to recover their funds and save their business, highlighting the importance of taking proactive measures to protect their business from unexpected financial crisis. Here are 5 crucial lessons that can be learned from Silicon Valley Bank collapse. Number 1, diversify your banking relationship. One of the key lessons from Silicon Valley collapse is the importance of diversifying your banking relationship. If your cash balance exceeds the maximum amount by covered FDIC deposit insurance, 25 million, it is essential to spread it out across the multiple institutions. The next lesson is negotiated exclusively clauses with lenders. Entrepreneurs should be cautious when signing exclusively clauses with lenders. Silicon Valley Bank was known for requiring this clause, which allowed the bank to monitor the financial health of its borrowers and provide preferential terms to this quick riskier business or less collateral. However, when Silicon Valley Bank failed to, several software companies almost lost everything because they had to deposit more funds with the bank than it was insured to hold. Lesson 3. Hire a seasoned CFO or financial expert. Having an experienced chief financial officer, CFO, or a financial expert who is well versed in financial tools and can monitor the financial health of significant partners is crucial for entrepreneurs. Designing a worst code rather than relying solely on people within your company's social circle or disseminate potentially alarming information can help ensure that you have someone who can actively monitor and manage financial risks. Lesson 4 is prioritize revenue generation over relying on VC funding. Customer income is an asset for startups, surpassing the allure of a large pool of venture capital funds for operational sustainability. Startups often find themselves caught in a catch-22 situation where they need to invest in product development before they can generate profit. However, some startups with significant financial reserve tend to overlook the importance of generating income. And last lesson is the importance of literature insurance against bank run. The prospect of more bank runs remains a frightening potential because of the Rapidity with the which targeted messages may be spread on social media and with which withdrawal can be made. It was the quickest bank failure in history due to the panicked quitting of founders and venture capitalists on Thursday. The collapse of Silicon Valley Bank highlights the need for entrepreneurs to plan and take preventive measures to protect their business. By following this lesson and being prepared for potential risks, entrepreneurs can mitigate uncertainty and safeguard their business against unforeseen events. That's all from us. Thank you, sir.